During the first quarter of this year, markets were focusing on the risk, and the number one risk was protectionism and the risk of commercial war between the US and other countries. There were also a question about inflation, accelerating inflation, especially in the US. In April, at the opposite, markets focused on positive fundamentals. And by positive fundamentals, we mean two things. First of all, economic growth. It's recovering, it's solid, synchronized, and it's one very positive factor for the world markets. And secondly, we are in the middle of the first quarter earnings season, and we do expect earnings to rise significantly, like the markets are also anticipating that. With the decline of the risk currently on the markets, we have seen a sharp increase in interest rates, and especially bond yields in the US went up significantly. They reached a 3% important level during a couple of days, and that was due to inflationary pressures coming partially from rising oil prices, but also that was due to anticipations that the Fed could deliver more hikes than expected. We continue to expect the Federal Reserve to raise interest rates 3 times this year and once in next year. And we haven't changed our target for the 10-year yield in the US, 3.25. For the Bund, we still expect 1.25 in the next 12 months. In other words, after the sharp rise in interest rates, we expect a softening of the pressure in the short run. The rise in interest rates was more rapid in the US than in Europe, probably because leading indicators in Europe were a little disappointing. However, the consequence was very clear on the dollar. We have seen a stronger dollar in the recent weeks, coming from 125 to 120 versus the euro, and that was a strong help for European equity markets. We maintain our fundamental optimistic view on equity markets, and this is essentially due to rising earnings. The consensus expects 12% earnings growth on a global basis. We do expect only 10%. That is also our expected return for the whole equity market. Earnings will continue to rise because margins will stay high in the US, partially thanks to the fiscal reform, and in Europe and Japan. We expect the operational leverage to help equity markets and to help the corporate to deliver significant earnings growth. However, even if volatility is low currently, volatility could come back rapidly. Trade war or the risk of protectionism could come back very rapidly. The geopolitical questions are still there, especially what could happen in Iran. Also in Europe, we are still facing some issues. The Brexit negotiations are actually very difficult. And in Italy, we could face new elections in this country very rapidly because there is still no majority, still no government. So to summarize, we do expect equity markets to rise because fundamentally earnings will deliver good growth, but volatility will rise. The low level of volatility in 2017 will not come back. This year is clearly different in terms of volatility environment. Thank you for your attention.